Okay, we're just finishing earnings season. There's a couple stocks that still haven't reported earnings, but I thought this would be a good time to kind of rack up what happened during this earnings season. Get you ready for next earnings season. Kind of want you to be aware of what goes on in earnings so that the story that I'm going to tell today is, as a retail investor, you need to beware of earnings. Beware of earnings. There's a lot of professionals that talk about the trading opportunities around earnings. And the thing is, these are full-time professionals. They've got many years of experience. They talk about adjusting trades that go wrong, but a lot of these trades go wrong so fast. I'm of the inkling that you don't throw good money after bad money. And a lot of the stuff that's taught is not for the retail investor. I'm diametrically opposed to this. And today what I'm going to do is talk to you about some of the strategies that are used and why they fail. Earnings is a very volatile time. I've seen good earnings reports and the stock gets clobbered. Vice versa, I've seen terrible earnings reports and the stock jumps like crazy. The thing is, the big institutions, the banks, the hedge funds, they don't really care about earnings. Earnings happened in the last quarter. They're focused on what's going to happen in the future. The stock market is always looking about 3 to 6 months ahead of time. Okay, so as we talk about these, this is going to be truly an educational webinar. I'm going to show you my website at the end and show you how you can become a free member. It's my offering today. I want you to join me and become a free member. But to summarize, the best way to trade earnings is to stay out. Okay, Renee gave a brief introduction to myself. I've been trading for 35 plus years. I do manage my own hedge fund. I've been a guest speaker on a number of sites and shows. But I currently run what I believe is the very best educational website out there. It's www.optionsinfinity.com. I don't teach because I can't do. I've done. This is how I make my living. I've done, and I still do, but I have a passion for teaching, because making money in the stock market is extremely difficult. I don't know why a number of people actually choose to get into the stock market. I think it's probably because they pick up a Wall Street Journal or whatever, and they look at a chart and they say, well, you know, I can see that. I could have done that. The problem is we trade from the right-hand side of the chart. We don't know what tomorrow beholds. And that's when you get into trouble. The thing is about the stock, I mean, you think about it for a second. Who is the stock market? Who are you going against when you're trying to make money in the stock market? You're going against the large institutions. You're going against the banks. You're going against the hedge fund managers. You're going against people that do this full time, that have a lot of money, that have a lot of tools. And for you to expect that you are going to outsmart these people is not reality. It's going to take you developing discipline, good money management, rock solid strategies. You need to check your ego at the door. You need to embrace losing. All these things need to come into your toolbox before you can even start to think about beating these guys at their game. Now, I do make money. And what I'm doing now is teaching people how to be a success. There are 3 rock solid strategies that I teach. I like to keep it simple. I teach following the trading rules. I teach you don't overtrade. And I teach the psychology of trading, checking your ego at the door. When you've got a losing trade, get out. How do you let a winning trade run? I use the Fibonacci extensions a lot for that. Now, every quarter, we go through earnings seasons. It's a time when the public companies announce their performance and give guidance for the coming months. That's the key. They give guidance for the coming months. We don't know what that guidance is until the CEO, CFO announce it on the conference call the day of earnings. It's a highly anticipated yet nervous time for investors, because they either get confirmation of the company's strong growth or news of a slowdown. Its earnings season is a gamble. It is a gamble. I am not a gambler. I am an investor. If you have a trade on a company going into earnings, you have a 50-50 chance of being right. Why not just take your money to the casino and put it all on red or black at the roulette table? It doesn't make sense. That's not being an investor. It scares me. Earnings season scares me, so I stay out. If I have a trade on a stock going into earnings, I'm out. I'm out. Yes, I've stayed in a couple times because I had a nice profit and I thought, well, okay, I can give a little of it back. And then the next day I look at it and say, well, it did it to me again, didn't it? Okay, it scares me. What I'm going to do is I'm going to show you 3 strategies. 3 common earning strategies that are taught. Now remember, there's no holy grail. Some of these are selling premium. I like to sell premium myself. Okay, I'm going to talk about the IV, the implied volatility crush, trade the big boys, then talk about these strategies, then talk about what I do. This is a chart of Google coming up to its last earnings. And what I've got down here on the lower portion is implied volatility. And you can see the implied volatility, and this is common for a lot of stocks. This is common. You can see applied volatility going up, 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 up. And then earnings are announced and that implied volatility drops like a rock. This is an IV crush. And basically what that is the market makers know that a lot of people anticipate earnings. So what they will do is the premiums on options will go up and up and up and up in anticipation of something big happening. And as soon as it's announced, that implied volatility will drop like a rock. You can see it going up, 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 up. Earnings, boom, down it comes. Up, 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 up. Earnings, boom, down it comes. So you look at that and you say, well, I ought to be able to profit from that knowledge. Okay, well, let's take a look and see if we can. But before I take a look at those examples, let's go a little bit further and understand what this means. The day before earnings, Google at the money. Remember, this is the options chain where in the yellow I've got in the money, In the white, I've got out of the money, and right here I've got what's called at the money options. Okay, options are made up by two components: intrinsic value and time value. These guys that are in the money do have intrinsic value. They do have some value. These guys here out of the money just have time value, and that time value erodes very quickly. Let's just take a peek at the money the day before earnings on Google. The 872.5, and this was worth 15 bucks. 15 bucks for the call. For the put, it was worth $12.60. So you've got $27.65, something like that. Okay, and the very next day when earnings is announced, the at the money options are worth $2.50. What happened to that $27? That's the implied volatility crush. It's gone. It's gone. It's not there anymore. The market makers ran that up. Earnings was announced, and out it comes. Okay. Now, some of the examples we're going to be talking about, and like I mentioned earlier, I do sell premium. I think selling premium makes a lot of sense. Selling premium basically is what you're doing is you are selling these options, and you're now being the house versus being the people that come in and put money on the roulette table and so forth. Okay. Now, what I'd like to do when I sell is I want to sell the big boys. What I did here is I just took, I set up a bull put spread, 43 days out, selling a delta of about 0.10, 10-point spread, and came up with these credit spreads. Okay, Amazon's price is around $3.14. The credit spread was 80 cents. Google was 80 cents. Chipotle Mexican Grill, $1.20. Okay, this is the credit that you can get, okay, with the delta here. Now, if you look at the cheaper stocks, the DuPont, the Nike, the Verizon, the Starbucks, you're only getting 29, 27, 19, 20 cents worth of credit. It's not worth doing. It's not worth, if you're going to sell premium, you want to sell premium on the big boys. Why? Well, this is, let's say you've got 19 cents when you sell this premium. First of all, you're going to have a vertical spread. That means you're going to try to get 2 trades at the midpoint to give you 19 cents worth of credit. Okay, that's hard to do, first of all. You're going to probably have some slippage. Well, boy, you don't have much room here for slippage. Then you're going to have commissions on top of that. And all of a sudden, this 19 cents that looked really good slips all the way down to 12, 13 cents. It just doesn't make sense to do credit spreads, vertical spreads, selling premium on stocks that are less than $100 a share. If you learn anything, that's a takeaway right here. Go with the big boys. Now you say, well, you know, I could just buy 4 DuPonts and get the same credit spread as I did with Amazon. Okay, 4 times the commission. 4 times, you got to pay 4 times the commission to get that credit spread. Okay, so now the slippage is just going to kill you, and that's why you want to stick with the big boys. Okay, let's talk about the first strategy. First strategy is the short strangle. The short strangle strategy requires the investors to simultaneously sell both a call and a put option on the same underlying security. The strike price must be above and below the current price. Okay, so let's go back to that option chain and take a peek at it and see what that means. That means that what I'm going to do is I am going to go out of the money. Let's say we're at 872. I'm going to go out $12.05 away from where it is trading, and I'm going to sell this $7.65. Now remember, that's $7.65 times one contract is 100 shares, so that's $76.50. Okay, not bad. Okay, and then what I'm going to do is I'm going to go out the same amount for the call, and I'm going to sell that for $9.40. You say, wow, that's pretty doggone nice. Pretty doggone nice. I'm going to sell the April 860 put and sell the April 885 call, and I'm going to take in $17.05 of credit times 100 shares per contract. I'm going to take in $1,705 per contract to set up a short strangle. And I'm sorry, this is a little fuzzy. This is I went into Wikipedia and pulled this off, and it's a little fuzzy. But basically, what it shows you, the short strangle. What I'm doing is what I'm trying to do is stay within this payout zone. Okay, and if it doesn't, then it's going to drop off quickly. Okay, but what I'm doing is I'm selling the premium here. I'm selling the premium here. I'm trying to have it stay in the middle so I can capture all that. Well, what happened the day of earnings? Well, sure enough, Google jumped, and we had a credit of $17.05. We had to buy it back the next day for $21.95. We lost 29 cents in a day. And that's ugly. You say, well, it was only $4. No, it wasn't. It was $490 per contract. Per contract. Okay. Another trade just recently. This is IBM. This was 4/18 of this year. You can see the applied volatility crush. And let's take a look at the setup on that for a short strangle. We sold the April 165 put, sold the 175 call, took in a credit of $1.69. The very next day, ouch, we lost 110% in one day. Ouch, ouch. So the short strangle, yeah, it works every once in a while. But boy, when it doesn't work, you get crushed. And why do that? That's a gamble. Why do that? Okay, so I'm going to cross off the short strangle. Let's look at the iron condor. The iron condor is basically a short strangle, only I'm going out and I'm buying an option further out of the money for protection. In other words, what I'm doing is I'm putting together two vertical spreads, a put spread and a call spread with the same expiration, 4 different strike prices. Okay, so let's take a look at this. On the IBM trade, what I'm doing is I am selling the 165, and then I'm going to buy back the 162.5. And I'm going to get the difference between these two, and that's the credit that I'm going to get. Same thing on the call side. I want to go out of the money. I'm going to sell this, but I'm going to buy back here. Okay, so you can see right off the bat, I'm not going to get as much credit, but I have protection in that it's going to come down. If I goes against me, it's going to come down, and I have bought one further out of the money that's going to keep me from a catastrophic loss. Well, let's see how this worked. We had the IBM dropped like crazy. And let's see, we set up the iron condor. where we sold the 165, bought the 162 put, we sold the 170, bought the 177 call, took in a credit of 88 cents, and all of a sudden the next day we get crushed. 164% in hours, then this is no help. So, okay. Now, like I said earlier, there are times that the iron condor works, but it's a 50-50 option. And you're going to lose more when it's wrong, when it's right, when it's wrong, than you will when it's right. So this is not it either. Say, okay, so what I'm going to do, I'm going to look at a long strangle. Okay, and a long strangle, what I'm going to do is I'm going to buy both a call option and a put option on the same underlying security. Like a straddle, the option's going to expire at the same time, but unlike the straddle, the options have different strike prices. In other words, what I'm going to do is this is a long strangle. I wanted a long straddle because what I want to do is I want to buy these both at the money. So now what I'm looking for is I'm kind of going against that volatility crush, and what I'm looking for is a big move. Okay, now you can just visually look at that and you say, well, if I'm going to buy this one for $2.60 and I'm going to buy this one for $3.17, I need IBM to move $5.77. Is that $5.77 before I can make any money? Well, the money managers are the market makers are no dummies. They look at this implied volatility, and Thinkorswim shows it to you right up here. They estimate that by the time of expiration, there'll be about a $5.90 move, and that's already part of the price. And these guys, this is what they do for a living. They are saying, I expect a move about $6. I'm putting that in the price, okay? But let's go ahead and do that. Let's buy those two and see what happens. Well, sure enough, we got a pretty nice little drop here, so we should have made some money. Well, we did. Finally, we bought the 170 put, we bought the 170 call, set up a straddle for a debit of 578. Okay, we bought this and we turned around and sold it the next day for 46%. Finally. Okay. All right. Well, I wonder how some of the other stocks have been doing that announced earnings on the same day. Well, let's take a look at Rockwell Automation. Rockwell Automation, we set up the same thing. We set up a strangle where we bought the May 160 put and bought the May 160 call. Cost us $8.60. Whoops. Boom. Oh no. Is there anything that works during earnings? Well, a lot of the professionals teach this stuff and they say this is fantastic and blah blah blah, and all we have to do is adjust. Well, the thing is, this happens before by the time the market opens. Let's say the earnings came out the day before, so the earnings was after the market closes. All right, so it's gonna know, in after hours trading, by the time the market opens, it's already going to have its move in place. Same thing's true if it does after market. It's going to overnight, and then you're going to see it the next day. So this happens in a matter of seconds, really, once the market opens. So how can you adjust that quickly? Well, yeah, you can make some adjustments. You can make some adjustments. You can turn these into butterflies. You can turn these into calendar spreads. You can do a number of things. But like I said earlier, in my mind, adjusting is like throwing good money after bad. It's not for the retail investor. And we are the retail investors. We are the retail investors. So what I do is stay out. And that means that when I've got a trade on and it's 2 days before earnings, I get out. If I've got a profit, if I've got a little loss, and it's 2 days before earnings, I get out. I do not go through earnings. Do not go through earnings. Now, let me talk to you about what I do. Like I said, I've been doing this for 35 plus years. This is how I make my living. I have my own large portfolio, plus I have a hedge fund that everything that I teach on my website, everything I teach, I actually do. Option Pro is one of my strategies, and what I have is basically 2 strategies with Options Pro. One is to when I get the proper setup, I actually will either buy or sell calls. The other strategy that I use is that I actually sell premium. I sell iron condors, bull puts, bear calls on the RUT, Amazon, and Google. Okay, I'm going to show you the actual trade records. What I do is I send out real-time text and email alerts notifying people when I see a trade evolving and exactly how I'm going to do it. 2014, I decided to take a challenge, to challenge myself to double my money in a year. Double my money in a year. And in 2014, I took $25,000 and took it up to $59,000 for 138% return. And you say, well, that's really good, Dale, but I want more. What? No, you don't. Okay, if you want more, this is all based on $1,000 per trade. So this is actually a 25 to 30x increase in the $1,000 per trade. That is huge. It's unheard of. And these are all based on trades that I released on the nightly blogs. These are all based on that. And I'm pretty proud of that. I'm pretty proud of that. Now, the SPY, which is the market standard, had a pretty good year too. It gained 12.5%. Had 2 losing months. I didn't. And you say, well, okay, that was 2014. 2015, well, I didn't quite double it. I got 85% that year. Last year, I had 109%. This year to date, I'm lagging a little bit. I'm only up 37% year to date. I'm very proud of this opportunity that I give people to teach them how to trade the market, how to be a success. And I use very few indicators. This is my trade setup. I'm basically just using the regression channel over here. The purple line is a regression line. It's calculated by 50% of the price being above, 50% of the price being below. It's an excellent trend line. And then the green is plus or minus 1 standard deviation. The gold is plus or minus 2 standard deviations. 95% of all prices will be contained within plus or minus 2 standard deviations. Now, the stock market doesn't know about statistics, but it sure does come pretty close to it. Every once in a while, you'll get an outlier, but this is like This is the meat inside the casing of a hot dog. Very seldom does it come out. And when it comes down here, there's a good possibility it's going to run back up and overshoot and then come back down, overshoot. Does that time and time again. The other thing I look at is if I want to make a trade that is overbought, I want the money flow index, which is the number of shares outstanding times the current price times the volume times something else. Okay, I want it going in the direction. So in other words, I'm looking for a put opportunity up here. I want this to be turning around. Then this is an indicator I developed myself. It's pretty simple. It's just the daily version of the weekly MACD. These are the exponential moving average lines, 5, 8, and 13. Those are Fibonacci numbers. And these numbers you see here are places where I look to get out and take profit. They're the Fibonacci numbers. That's it. That's what I look at. Okay, that's what I look at. Now here's an actual trade. Here's an actual trade in IBM this year, February 27th. You can see that this was February 27th was right around here. We went ahead and bought the April 185 put for $8.05. We sold it when it got down here to the Fibonacci 261. That's an overextended period. All right, for a 43% profit. And you say, well, why'd you get out there? Well, because the Fibonacci numbers that I use these all the time, they are so valuable, told me to get out. And I wasn't greedy, and I took that profit and got out. And the other thing was I knew earnings was just around the corner. And you say, well, if you would have just stayed in, you would have made a boatload. Yeah, I would have, but there's a good possibility that might have gone up here. So why take that 43% off the table that we worked hard to get and put it on red or black? No, I take it off the table. This was an actual trade, okay? Now, the other side of what I do is to sell premium. Selling premium with either iron condors. You can see here was an iron condor where I sold a bear call and sold a bull put. And let's just, I don't want to go into all the details on what I do there. I watch the Arun indicator, but just look at these returns. 105%, 150%, 55, 120, 110, 130. Well, I was down 70. 140, 130, down 40. Okay, you say, well, okay, that was bad. That was then. How about now? How about now? Well, how about now? How about the last 5 months? 110%, 135%, 120%, 65%, 105%. We're out right now. We're out. We have made our 105% on our June contracts, and we are out. Now, this is one of 3 strategies that I teach and actually work with you to tell you what I'm doing. So what I'd like to do, I've got a little bit of time left, is to go over to my website, and let me just bring this over. It is www.optionsinfinity.com, and you can see that right off the bat, all you have to do is come over here and become a free member. We have over 5,000 free members. They have access to 126 strategy videos. You can learn about me. You can see that I'm, what I talk about and whether or not it comes to fruition. I want you to really, before you embark on anything, I want you to have full confidence in the person that you're embarking with. Okay. These are the three strategies that I teach. I talked to you about Options Pro. The other one is SPX War, weekly option regression. And this is based on the fact that the SPX is traded a lot by the large institutions and the banks and the hedge funds. And when it deviates from the mean, it will revert back to the mean. And we take advantage of the reversion back to the mean. And these are weekly option trades. The last one is using ETFs to hedge our portfolio. A lot of my big investors, well, I would say you need a portfolio of about $50,000 to even worry about hedging. But those of you that do, if you want to keep your portfolio intact and not be hurt and not worry about drawdowns, ETF hedging is what you want to do. These are more short-term. I would say this is the best one to start out with. And then maybe you want to migrate into this one, okay? But as a free member, let me just show you some, there's Options 101, options leverage, how I pick stocks, how I set up the charts. And of course, I use Thinkorswim. I think they're a great trading platform. I'm not really associated with them financially at all. I just think they're a great platform. How you determine your trade size so that you don't overtrade. One of the number one reasons why retail investors fail is the overtrade. Talk a little bit about the psychology of trading. You won't find this anywhere else. The psychology of trading. Developing a business plan for your trading business. The regression channels, the Fibonacci's and measured moves, the macro MACD, swing trade, credit spreads, weekly options, and much, much, much more. Just become a free membership. Keep scrolling down. This gives you some of the statistics of the programs that I have available as far as the trades per week, the average hold time, the winning trades, and then there are some testimonials at the bottom here. So what I'd really like you to do today is just become a free member. Join me and really listen to what I have to say as far as the different strategies and the psychology and how not to trade, and what are the things that losing, what are the number, the reasons why people lose money and how you can avoid that, and really become familiar with me and become happy with me, and then join one of my programs, and you'll be glad you did. This is what I do. I do this for a living, and this is what I teach.